This will be a good conversation. Everybody, welcome to another episode of Get Think Tanked. My name is Michael Guyett. I'm a member of the ETF think tank at Title Financial Group. For those that are not aware, Title Financial Group's in our RIA. We help bring ETFs to market, which means if any of you that are watching want to bring an ETF to market, reach out to us because that's what we do as our primary business. And we work a lot of thought leaders with people like Peter Atwater, who's among my favorites in this space. So we'll have a good conversation with my colleagues interviewing Mr. Atwater here. Mr. Weisskopf, please introduce yourself to this wonderful audience.
Of course. So I'm a member of the investment committee at Title Financial Group, also lead ETF strategist for the ETF think tank, where we work with advisors and hopefully from a research standpoint, helping them build better mousetraps, otherwise known as models. And I'm also the co-PM of Block.
Cynthia.
I'll go next. Hey, everybody. Cynthia Murphy, head of research for the ETF think tank. Thanks, everybody, for joining. We have a great guest today and a great show, and we're excited to be here.
And then the man of the hour, Mr. Peter Atwater. For those who don't know who you are, introduce yourself, please.
Sure. Peter Atwater. I'm an adjunct professor at William & Mary. I study confidence, consult through a firm called Financial Insights, and just finished a book called The Confidence Map, which looks at how our feelings of certainty and control impact what we do.
Which is going to be a very good framework for this conversation, because it does seem like we are at some kind of a crossroads cycle-wise, right? I've had a number of conversations with advisors bringing up this point that it seems like the Fed is done. It seems like the economy now is either going to respond in a negative way to the lagged effects of the fastest rate hike cycle in history, or respond positively, in which case the Fed stuck the soft landing. Where are we? Because I got to tell you, if we're going to be talking about confidence, I don't know if there's a high degree of confidence in either scenario. I think people want to believe that the Fed was able to pull off the soft landing, but I do think that there's this nagging disbelief that they actually did.
Yeah. So if I were to look across the markets, the tells are interesting. You have confidence in stocks and bonds that is intensely correlated. We've just seen a resurrection of the balanced portfolio in November, and the question is, does that continue? And to me, it's interesting because it becomes this self-feeding frenzy where lower rates, higher stock prices, lower rates, higher stock prices. You can see the narrative swirling, and you have this great backdrop right now of falling energy prices. So everything organizes itself really nicely to suggest kind of an environment where you have an extraordinary market melt up. Having said that, the enthusiasm has become so extreme so quickly that you also have the high likelihood of both now moving in opposition. And what's interesting to me sentiment-wise is, we talk about stocks and bonds being correlated, but we can throw in FX, we can throw in mood more broadly. And, the downside scenario here to me is much more troubling beyond the markets, just because it looks like high energy prices, high interest rates, and the late 1970s on steroids. So it's a lady or the tiger moment. And I know it sounds like an economist talking using both of my hands, but this is one of those times where I've said this a lot to my clients, prepare for what you imagine, but be prepared for what you can't imagine, because the low probability events will be high impact.
That's a great lead in to one of my concerns. People are always going to be more confident when they're employed. And we're at a point right now where a lot of CEOs don't want to lay people off because, well, their stocks are doing so well, right? But, cost of capital needs to go lower or we're going to have more problems, right? Psychologically, how do things work out when people start getting laid off into a recession? Because we may not want a recession, but it's a healthy thing.
Well, and it may be a recession that mirrors a 1970s style recession. So it's got a stagflation quality to it, where the cost of living is going up at the same time the economy is coming to a grinding halt. And that's really the double whammy in terms of mood. It's one thing if the cost of things is falling around you. It's another thing if I'm losing my job and the cost of living is going up at the same time.
Sorry, I meant to raise my hand, but I didn't. But I wanted to ask, so from that perspective, just the concept of consumer sentiment versus the reality of the economy. And, we tend to see one as a proxy for the other, but it really looks like there's a disconnect there. So, how are you evaluating or assessing the consumer sentiment part of the outlook here?
Yeah, I think so many in the finance and economic world think that all the consumer focuses on are economic factors in impacting their mood. And so they look, to your point, they look at unemployment, they look at other items and they go, wow, I can't believe people feel so bad. And it's like, well, we are not singularly influenced in why we feel the way we do. And, COVID was a great example that, the disease causing confidence to fall, not the economic consequences of the disease. I mean, it was, those were sort of a secondary thought. So let's talk about some of the economic factors, unaffordability of housing, unaffordability in terms of rent, high inflation and the stuff we need. And even where prices have come down, like at the pump, people don't trust that that's going to last. So you've got some anchoring bias that's getting in the way. But to me, they're part of a broader environment where you've got a backdrop of war, now wars. You've got political uncertainty with the 2024 election coming up. You've still got a whole bunch of social issues that are unresolved for many. So to me, it's not a single dynamic. We're just in a shitty mood. And that then frames how I look at my job. So even before I'm unemployed, I'm now worried about being unemployed, or I don't feel empowered at work. So having a job isn't giving me the boost in confidence that it once did, because people know that corporations today are basically, when times are good, they'll hire me. When times are bad, they'll fire me. So there's a different social contract that we have. And again, if I'm not feeling strong about life in general, I'm not going to be looking at the glass half full on the employment side, even though it may be that and then some.
Is mood shittier when you have higher inflation or when you have deflation / recession? And I say that purposely because I think if you are in a high inflation environment, people probably get even more frustrated because no matter how hard they work, they can't keep up. And at least if you have a recession, okay, you're not working. Yes, you're still worried about expenses, but there's a safety net. So maybe the mood's a little bit different from that perspective. So, are we in an environment where the social fabric is more strained in elevated inflation as opposed to a recession?
Yeah, I think economists underappreciate the psychological impact of inflation. It imprisons us. It's not just that things are unaffordable, it's that we don't have control. We don't have certainty. And so when prices go up, particularly of the things that we need, food, energy, housing, that creates real stress. And, if you want to go back to the the Arab Spring, you can see the real clear connection between food inflation and social unrest. So to your point, yeah, I think this is an asymmetric environment where higher inflation feels worse than a deflationary environment. It's certainly more immediate.
And today we're also in a position, I think, where we have less confidence as a society in our politicians. I think that's probably an understatement than what's been in the past, right? Because things are so out of control with our debt and what they can actually have an impact on. People are completely losing confidence, in my judgment, on what the politicians can do. Have you done any or seen any studies on, when we're in this kind of situation, what the politicians can do to inspire more confidence?
Yeah, presidents and political leaders are only as good as we feel. So there's a real reflexive quality to how we look at leaders, how we look at institutions. And so to me, Dan, those institutions tend to be the tail to our dog. And so they're going to mirror our combativeness, they're going to mirror our impulsiveness, our strain and stress. And we don't have today political leaders with a lot of social capital who can afford to be courageous. And so, that sense that we would rally around somebody is going to be difficult. And more likely what you're going to see are grassroots leaders who come to the fore that the crowd starts to fall in behind.
Can I ask, Peter, I'm curious, actually, like more of a philosophical conversation about confidence itself. I'm just curious in the context of what we're discussing in terms of market impact, how we feel about the world impact. Is the opposite of confidence doubt? And if it is doubt, is there no scenario in which a general feeling of doubt is productive? Meaning, could we potentially be better investors if we're actually not confident on what comes next? Is there any outlook here where not being totally confident on what happens next is actually a positive thing?
Yeah, so the opposite of being confident is being vulnerable. So to be confident, I need certainty and control. When I don't have confidence, I feel a sense of powerlessness amid uncertainty. And that is the definition of vulnerable. So we're lousy at making financial decisions when we're vulnerable, because we tend to emphasize the present as opposed to the future. And we emphasize things that are concrete as opposed to abstract. So our willingness to bet on the future in a way that would be highly productive disappears when we don't have confidence. And you see that in an extreme where we're holding on to cash for dear life. That's we have to have it in our physical hands. But if you think about all of the decisions that we're making as investors, we need to be careful anytime we can assign a high probability to either a great outcome or a terrible outcome. And that is to me a measure of overconfidence that we ignore too much. If you're sure it's going to go bad and are inclined to sell, you need to catch yourself. Or you think it's definitely going up, I got to buy. You need to catch yourself. And often we see that in terms of being overconfident, but we're routinely underconfident, and we don't pay attention to underconfidence, I think, as much as we should, particularly in moments like this, where mood is so dour that we forget that in that dourness there may be opportunity, and we certainly saw that a month and a half ago.
Mhm.
Yeah, it's always amazing to me how confident bears are when the market's going down. And usually the bearish argument is more rational than the bullish argument, in my judgment, because they can paint the risks that are out there, right, as with great clarity. But the bulls have to usually take a long-term perspective, right? So a year, 2 years, 3 years, whatever out versus a bearish sentiment, which is a month, 2 months, 3 months, as the data is providing evidence of what's going bad, right? Have you looked at that argument that I'm making between confidence by people who are bullish versus people who are bearish?
Yeah, so our bearishness stories tend to be very simplistic, very black and white. They feel realer to us, truthier than the stories we tell when confidence is high. Now, having said that, if you listen to the stories that we're telling at extremes in confidence, to the audience, they have that same truthiness, that same black and whiteness. There is an equal aggressiveness to those messages. But when we're vulnerable, those dour messages sell like hotcakes, and you really see this today on the political front, where I think we have this bubble in doom, and at some point we're gonna get tired of that and move on. But I think even Neil Howe says that his books on the fourth turning sell much better when confidence is falling than when it's rising. I mean, we're just in that sell, give me every reason it's going to go bad mode.
Yeah, but yet, if you're going to think short term, you also have to think about how to get back in, right? And that's the hardest part about bearishness, because perma bears don't do well as investors. I mean, that's just a statistical fact. So the psychology between a bear person and a bull is just so hard to quantify for me. My dad was a perma bear. By the way, I should just disclose that fact.
Yeah, and I think if you were to go back and look sort of 6 weeks ago, the scenario was very asymmetric. You had a low probability of a high impact event and a much higher probability of the markets turning. And I think sometimes we need to just assign probabilities. As markets move, the probability of them continuing in that direction becomes lower while the crowd thinks it's becoming higher. It's got to go higher, to me is the bellwether of that bell ringing of no, when everybody's yelling that we're now more likely to go the other direction.
And my last point on this, and we should just move on to something else, but when the Treasury was downgraded, right, recently, that was, to me, a major catalyst for bonds to have problems, right? And yet that wasn't the case, right? And people all of a sudden rallied around it, and in anticipation of what? A recession?
Yeah, I mean, I tend to look at the rating agencies as a lagging indicator. They follow mood, act on it at precisely the wrong time, and in some ways, policymakers do the same. I mean, when you think about groups that act as committees, they're inherently behind the crowd.
Yeah.
And bureaucratic committees even more so.
But how much are we actually controlling our own mood? Like, whether you're a bear or a bull, aren't we constantly looking for confirmation of what we believe. So don't we tend to go find those people that are yelling really loud, whatever we already want to be sucked into and get into that? I mean, how does that work in terms of, how we take control of our own sentiment and snap out of it at the right time?
Yeah, so we choose the media that we follow. A lot of folks say, the media is making me feel this, the media is making me feel that. It's like, whoa, 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 whoa. You chose the media. We have choice. So whatever you're turning on deliberately because it resonates and is relevant to you. And you can see as our mood changes, what we choose as our news sources and media sources changes with us. There was a great example today in the Wall Street Journal where people are migrating to one source because they're unhappy with another. And even within media sources, we will follow those on Twitter that we think align with us. It's really difficult. And I do this for a living. I mean, I'm looking at people who are vehemently opposed to the way I think. My Twitter feed is filled with both sides of the aisle politically, both sides of the bull bear, and it's hard to go back and forth to reconcile all of those differences. So, but we need to be really careful today because we are enabled to live in very echoing chambers more than ever before. And so the smaller your sources of affirmation, the more likely you are to fall victim to the mood of that crowd.
But isn't that the more likely you are also to be more confident? Because if everybody around you is agreeing with you, then you have this false sense of total confidence, right?
Absolutely. They're affirming your view at every tweet, every Instagram post, every message that you're getting.
That's why Michael's so confident. Everybody agrees with him.
Everybody agrees with me.
Well, I mean, we were joking sort of before this began. You can watch as the crowd agrees and disagrees with Michael, and I will confess that at times that's a useful indicator.
I will confess it is unequivocally a useful indicator because I've seen it at many instances, especially at major turning points. But I feel like part of this has to also relate around volatility of changing emotions. Right, which also relates to some extent to attention spans, because I have to tell you, I am blown away how, for 1 week everybody's screaming about oil spiking with Israel Hamas, and then the next week nobody talks about it. 1 week they talk about Ukraine Russia, next week they don't talk about it. It's beyond even geopolitical stuff, right? And anytime there's any kind of horrendous thing that's happening, the attention span's not there, so the mood gets very dour, and then suddenly it's like, all right, what's the next thing?
Yeah, and the technology today, I during the great financial crisis, I spent a lot of time reading financial crisis porn, and one of the things that stood out to me was a comment about the Panic of 1857. You say, why do we care about that one? Well, that one happened over a span of weeks as opposed to months. You say, well, why? Well, the telegraph. And if you look at the transitions in telecommunication, telegraph, radio, television, the internet, now social media, the speed at which mood is translating into action is getting compressed. At the same time, the size of the crowd is moving exponentially larger. And so we have this situation where, to your point, the speed at which my mood changes translating into news stories, translating into action is like never before. And, you could see that to the upside with meme stocks. I think we have yet to be tested in terms of what does it mean when you have social media empowered by online trading tools and a major event triggering a collective move in or out of the markets.
But couldn't you argue then, Peter, that this is the perfect argument for super, super, super vanilla passive investing? Kind of like, you know, we don't have the attention span, we're inundated with information, we are naturally inclined to have this confirmation bias, live in echo chambers, and we don't know what happens next. So, I mean, it sounds like the perfect argument for saying just own the whole market and go do something else.
Yeah, and I think that argument holds, except that the analogy that I would use is it becomes like passengers on an airplane. Passive investing to me is my willingness to leave the driving to others.
Mm-hmm.
And so, as we know from our own life experience, turbulence creates a dramatic change in cabin attitude. And so we may tolerate modest air turbulence, but there, anything much beyond that, people who've never been religious are suddenly in prayer. And I don't think passive investing has been tested in terms of that kind of turbulence with today's social media and trading tools. I'm not condemning active versus passive. I'm just saying that we haven't tested what that airplane environment is really going to look like.
No, I think, Peter, you said that passive stinks, by the way. That's what I heard you say. I'm just kidding. No, but to your point, actually, when I look at the market cap weighted passive funds, I'm talking about equities right now, obviously, and the confidence in them is wonderful, and it's well earned. Let's be honest about it. But the economics behind them is a little bit scary to me. And sometimes people say, "See no evil, there is no evil," right? And when you see certain stocks, no evil in Apple, but Apple's a wonderful company, wonderful product, but it's so overweighted in the passive indexes, and the company's not growing. It's all about confidence that Apple's going to continue to rally. I mean, that to me concerns me a lot, because the reverse can be true. If a stock like that has a problem, that it's going to hurt a lot of people.
Well, and you also have a situation where we have lumped Apple thematically with 6 other stocks. And when I think about the Magnificent Seven, they are all highly confidence correlated. So it is likely that if mood in one deteriorates, mood in all will deteriorate with it. So this lack of confidence diversification inside of the indices today bothers me. I'm also really troubled by the lack of confidence diversification as it relates to balanced portfolios. Stock and bond investor mood today is one and the same. We are conjoined emotionally between fixed income and equities, and have been that way since, to me, sentiment peaked in early 2021, and you had negative interest rates on the fixed income side. So I think that all of these very diversified portfolios that people are looking at, because the pie charts are multicolored, are missing a big point that mood-wise, they own one pie. And today that pie is back to euphoric. I mean, each piece, stocks, bonds, it's all really piping hot today.
Yeah, and now we go into an economic environment, right, at some point, where whether it's stagflation or recession, and you've got a mega cap out there such as Apple, I don't know, maybe $600, $700, $800 for a new phone would be harder if we're in a recession, or if prices are hurting me. it's maybe I'm just off on a tangent, so forgive me on that.
Well, and these companies are also highly symbolic, and so they're likely to, become target more broadly when mood falls.
We're talking a lot about the U.S., by the way, right now, and when you're talking about mood falls internationally, things are far different, right? People are just less confident about investing outside of the U.S., at least here in the U.S. What do you think it would take for folks to be more confident in investing outside of the U.S., whether it's emerging markets or Europe, et cetera? Because that's hugely challenging, I find, getting people to do.
Yeah. So when we lack confidence, we are naturally xenophobic. So things that are far away from us, socially, geographically, temporally, they're much more abstract. And when confidence is low, we don't have the cognitive bandwidth to consider them. And so in order for us, if you were to look at our willingness to invest overseas, you could almost analogize it to our willingness to travel abroad. And when confidence is low, we don't travel abroad. We don't get out of the house. We don't interact. We turn inward. And so to invest overseas today is to reject our natural response to low confidence. And that's a really tough sell. And we can talk about the relative opportunities up and down, till we're blue in the face, but you're fighting a psychological force where I want certainty around me, and I'm going to leave the rest of the world to the rest of the world.
Well, I know Dan wants to close up. We're closing up in about 5 minutes, Peter. Talking about hyperinflation versus deflation, kind of some kind of macro looking forward. But before we go there, Dan, I just wanted to ask, this book you just put out, The Confidence Map. So, give us a little bit more. I'm curious, like, what is the key insight there? What's the discovery about either our obsession with being in control of things that we really are not, or how we navigate the world through confidence or lack of confidence?
Yeah, I think we have a terrible understanding of confidence. We think it's either what I call confidence theater, all about appearances, or self-confidence, but it's really about the certainty and control in what we see around us. And what I tried to do in the book was to say, as those change, our preferences change in ways that are highly predictable. Our stories change in ways that, again, are highly predictable. And our actions change in ways that are highly predictable. And so just knowing where your confidence level is, or where, more importantly to me, where the crowd's confidence level is, you can do a much better job of anticipating what's going to happen next. And that's particularly true because I can look at it in terms of the stories, and the stories are going to tell me everything I need to know about how confident people are.
Which goes back to earlier, you were talking about the value of assigning probabilities to, potential outcomes. I actually find that really difficult to do. I see here at home, my husband is always like, well, this is 12% likely to happen. I'm like, where does that number even come from? I actually don't think that's an intuitive exercise if you're actually going to put an effort to do it. So how do you go about assigning probabilities to outcomes?
So what I try to do, and I show in the book, is I have a very visual framework. And you can see probabilities assigned simply by where people put themselves or others on the map, because our location in terms of our feelings of certainty and control are telling everything about they're revealing everything I feel about those probabilities. So a highly confident person has a very high probability in their mind of the outcomes. And you can start to see just simply by plotting locations, the odds that go along with that.
That's fascinating. How did you even get started on this journey? I'm curious. What was the seed that set you off in search of understanding confidence?
As we're coming out of the great financial crisis, everybody was saying the markets it's just going to get worse and worse and worse. And then the market started to turn. And that contradiction made me really think about, well, what defines a low in confidence? How would we know that the bottom is here? And what are the consistent characteristics of the decision making at lows in confidence? And what I found was, they're all focused on me here now. They're all focused on very concrete, absolutes. It's highly impulsive, and the backdrop of behavior is spectacular in terms of fight, flight, freeze, follow, and fuck it. I mean, you can see people falling into those categories of decision making at every major low.
Yeah, there's a beauty to how predictably screwed up we all are.
A lot of books on decision making focus on what we do wrong. I've tried in this book to say, this is just what we do. And if you're going to be better at decision making, you need to understand your baseline.
Mm-hmm. Dan, I'll let you take it back to the macro talk.
No, I mean, listen, at the end of the day, my question goes back to our wonderful politicians. So in the context of the economic backdrop we have going forward, right? What impact do you think the elections will have on the probabilities of the market going? By the way, let me be clear. Which market going higher? Because that's the big issue. Which market do you want to be invested in? Bonds, fixed income, commodities, right? I guess bottom line, my question is, what impact does the election have across different markets?
So I'm anticipating, Dan, that all of the fireworks precede the election, that we are inherently forward-looking individuals. And as the polls change, reflecting our mood, so will the market choices. As an incumbent, Biden will do better if mood rises. He will do less well if mood falls further, because we vote incumbents out. It's not about who we elect, it's who we elect, who we drum out of office when confidence is low. And so you can see, you could see this month that the kinds of candidates that people are now talking about here at the end of November is a more moderate candidate in Nikki Haley than we were talking about 6 weeks ago. So the moderation outlook will change alongside the markets. If markets keep going up, you'll start to see a more centrist pull broadly. Markets decline, it's going to be much more aggressive candidates left and right. And so I wouldn't look to policymakers to solving the problem as much as reflecting the problem that is delivered to them when by the time the election takes place. As I said, the fireworks are going to be before November.
Yeah, the idea that they reflect us, it's not very confidence boosting. I'll just say that, Peter. So thanks for that. So I think we're at the top of the hour, right, Gayed? Dan, I think we're gonna be wrapping it up.
That's good.
Thank you so much, Peter. Super, super interesting talking to you. Everybody, check out the confidence map. I can't wait to read it. Sounds really interesting. And follow Peter on Twitter, follow each of us. Thanks for joining us. And thank you so much, Peter, again, for joining us on the show today.
Thanks, Cynthia. Thank you, Dan.
Good to see you.
Bye, everybody.
Thank you, Mr. Guy. And thank you, Mr. Guyette, of course, always.
Thank you all. Cheers.
Yep.